What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to break down everything that Jerome Powell basically talked about on Friday during the Jackson Hole Economic Symposium. And I'm going to really kind of simplify exactly what he was talking about, right? Because obviously he does talk in cryptic messaging. So hope you guys enjoy it, find it helpful. If you do, make sure that you drop a like. We'll talk a little bit about the markets as well, talk about the technical levels to watch for this week. And of course, GDP numbers are coming out later this week. And I'll also go over the inflation and interest rate expectations from both the Fed and of course the market as well, and how we are now starting to kind of come around the Federal Reserve's expectations of interest rates that they have already penciled in on the summary of economic projections. The market is now warming up to the idea that there is going to be one more rate hike in 2023. So again, link's going to be down below if you're interested in joining us. 16% annual discount available for another 3 to 4 days until the end of this month. And we do have the Labor Day sale for our courses, so fundamental technical analysis courses, options course, 50 to 60% off. That's available for the next few days as well. Link's going to be down below, coupon code LABOR4. So first thing first, I want to talk about what is the one metric that they are going to be focusing on, right? The Federal Reserve, they don't care about CPI, they don't care about PPI. The one metric that they are solely going to be focusing on when it comes to inflation is PCE, right? That's the personal consumption expenditure. And it's just a little bit different in the way that's calculated with respect to CPI and PPI. And more specifically, as Jerome Powell has already mentioned, is core inflation, right? Core PCE is what they are really going to be focusing on. And this right here is a chart that basically shows us that amid discussing various inflation dynamics, the progress made so far, the lack of progress in some corners, and the uncertainty around it, he showed this chart where the Fed staff is forecasting that core PCE for July to be announced on August 31st will re-accelerate, right? So that's the black line they basically are talking about. That's a 12-month core PCE. And that's still sitting at a little bit over 4% expected to, once again, you see that re-acceleration tick higher. It's going to re-accelerate a little bit further once again, even though month over month or on a 6-month, 3-month basis, we're still showing signs of deceleration. On a year-over-year basis, 12-month basis, it is expected to once again be a little bit higher and stay above the Fed's target of 2%. That's another thing, right? He once again said 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. Very important keywords here are achieving and sustaining a stance of monetary policy, basically staying where we are, right? So that's basically ruling out rate cuts at this point. And we know that they've penciled in 2024 rate cuts, 4 rate cuts, 100 basis points, getting down from 5.6 to 4.6%. But the likelihood of that happening is completely and solely dependent on core inflation. If it doesn't come down below 4%, closer to 2%, if core inflation doesn't come down to the Fed's target, which again, Jerome Powell said that 2% is and will be our inflation target. They're not moving on that inflation target, obviously. So if it doesn't come down, guess what? Those rate cuts are going to be out of the picture as well, because Jerome Powell has once again said that this is our goal. 2% is our goal, and we are going to do everything it takes to make sure that monetary policy is restrictive enough to bring inflation down to that level over time. And over time meaning that it's not going to come down next week, it's not going to come down next month, right? It's going to come down over time. And for that, they are prepared. This is what he said, and I quote, "We are prepared to raise rates further if appropriate, and intend to hold policy at a restrictive level until we are confident that inflation is moving substantially down towards our objective." And that objective, of course, is 2%, as tracked by the core PCE price index. He said that 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. And the price stability, he confirmed today, is 2%, as once again tracked by core PCE. And getting inflation sustainably back down to 2% is expected to require a period of below trend economic growth, as well as some softening in the labor conditions as well, right? Unless we see the economy slowing down and cooling off a little bit, and the labor market also cooling off with wages not going up the way they are, we're not going to see that below trend growth in inflation at below 2%. That's what he's mentioning. And right now, it's the exact opposite, right? He said below trend economic growth isn't happening right now. On the contrary, the economy has re-accelerated, with the Atlanta Fed now forecasting, GDP growth of over 5%. Like that's crazy, right? And he said that the Federal Reserve is attentive to signs the economy may not be cooling as expected. And right now, so far this year, GDP growth has come in above expectations and above its longer run trend of first quarter increasing 2%, second quarter increasing 2.4%, and Q3 has started out even stronger. Won't be surprised if it's over 3 to 4%. And recent readings on consumer spending have been especially robust as well. So there's a lot of challenges and that are common to all tightening cycles. He also goes on by saying that real interest rates are now positive and well above mainstream estimates of the neutral policy rate. And we see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation, but we cannot identify with certainty the neutral rate of interest rates, and thus there's always uncertainty about the precise level of monetary policy restraint. The assessment is further complicated by uncertainty around the duration of the lags with which monetary policy tightening affects economic activity and especially inflation. So what he's really saying is that, look, there is still a lot of uncertainty. We don't know what our terminal rate's going to be. We may have penciled in 5.6% 6 months ago, but that may not be the case. And guess what? The market is now pricing in a probability of what? A 6% terminal rate, 600 basis points for us to get up to that level. I'll show you guys there in just a minute. But finally, he says, in addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. And these changing dynamics may or may not persist. And this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Of course, they can't do too little because that then inflation becomes a little bit more entrenched into the economy. They can do too much because then, of course, economy is going to come under a lot of pressure with respect to recession. So bottom line is we still don't know. Even after this meeting, Federal Reserve themselves, and of course, even economists and everybody that you ask still doesn't know what that terminal rate is going to look like, say 3 months or 6 months down the road. And after this, after the Jackson Hole Economic Symposium, we did flip. Market is now fully on board with another rate hike in November. So September, we're still expecting a pause. And then November, the market's fully on board. Earlier, it wasn't. Now we are at a 51% probability that we're going to see another 25 basis point hike. We're going to stay there. The only problem is the market is pricing in 1, 2, 3, 4, 5 rate cuts. The Federal Reserve's penciled in 4. But after the Jackson Hole economic speech, it looks like it's not going to do that anytime soon unless core inflation comes down to 2%. Unless core inflation is down to 2%, I don't think that we can be expecting rate cuts. And if this rate cut probability is what's really driving the markets higher and the rally that we've seen, then we are certainly opening ourselves up for a rude awakening later this year or early next year when the Federal Reserve once again smacks down the potential possibility of rate cuts. This right here is the expectations for the November meeting, I believe. So November meeting, again, 51%. And you can see how the expectations have increased over time. And this is for 600 basis points, right? We have, once again, increased to almost 10, 11%. Probability the Federal Reserve is going to actually raise rates not by 25, by 50 basis points in November and get us to over 5.75 to 6%. This right here is going to be for the December probability. And December probability was literally, there was no probability for us to even get up to 5.75 or 6%. And now, once again, we're at over 10 to 11% chance the Federal Reserve might end up raising rates to 5.75 to 6%. So not one, but potential 2 rate hikes, because the first one's pretty locked in now at this point after the speech that, we're going to see some more restrictive levels. We're going to see some more tightening. We need to see below trend growth in inflation in order for it to get down to 2%, which we haven't seen yet. Economy continues to be strong. Wage growth continues to be strong. Labor market continues to be strong. So the bottom line is, I think one more rate hikes is pretty much a done deal at this point. Another rate hike is on the table, and rate cuts are becoming less and less likely. So it really comes down to a question of what exactly is the market rallying on, right? What is the reason the markets are rallying? Is it the fact that the Federal Reserve is coming to an end towards a rate hike cycle? Or is it the fact that the Federal Reserve is potentially going to start cutting rates in 2024? Because if it's the latter, there's a lot of uncertainty around that. If it's the former, we've got more predictability, right? Maybe one more rate hike, possibly 2, but I don't think it's going to be more than that. But it's just kind of understanding market psychology and of course what the market is really pricing in. That's why instead of predicting that, I think it's a much better way to approach the markets and looking at, okay, when can I really find good deals and where is good risk reward ratios, right? What's the fair value for the market? What's the fair value for my stocks? And regardless of what goes on the macro picture, macro front, I'm a buyer or a seller regardless of those things, right? Depending on the risk and reward and depending on the fair values and the price targets. So that's going to be my approach. Wanted to go over and break down, some of the key takeaways from Jerome Powell's speech. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. 16% annual discount available till the end of this month. And of course, the fundamental tech analysis courses with the coupon code LABOR4 available for the next few days as well. As always, happy investing. I'll see you all in the next video.